So a couple of things, a little bit of a change of plan for Thursday. Originally I said it was going to be canceled. What I'm going to do instead, have Evan, first new grade, the exams come in and go over the solution to the midterm. So if you're interested in that, you can probably ask some questions. You have questions about your exam and that sort of thing. I posted the solution today on the class website. So it's sitting there. Sorry that took so long. I just kept slipping my mind. But it's there now. So you can see what was used as the key to grade the exams. If you do happen to have questions after you've looked at the key, the procedure I want you to go through is to first see Evan Fuller, the person who graded it. He has the best idea about how he graded everyone else and what a fair change is and what isn't. So talk to him first. He'll have power to change your grades and all that. If you're not satisfied after talking to him, his instructions will be, don't get in a big argument about it. If he says, no, I don't think it should be changed, and you still disagree, then just come to me and I'll be the final say. So when there's a disagreement over it, then I'll be the one who arbitrates finally. Basically, I'll take the position that the grade is right unless there's evidence to the contrary. It'll be up to you to make the case, and if you make the case, then I'll change it. There's no reason not to give you the grade that you deserve. But it just works best, partly to make you go to the GTF first. It gives them an incentive. They know I do this. They're much less likely to grade sloppily. Because when you do, you end up with 20, 30 people in your office really wanting to kill you. And so it makes them do a better job grading. And so it creates the right incentive. And I think it's more equitable that way. Because as I said, you want treat people fairly. You need the person who understands what each part of the question is worth in their mind because they graded it. So yes, that's what we'll do for Thursday, and then we'll start again normally on Tuesday. So what we've been doing is building a model of the Phillips curve. And so the Phillips curve is the relationship between inflation and unemployment. And you can get to the Phillips curve, it's an aggregate supply curve. One way to get to the Phillips curve is to take our aggregate supply curve that we derive. So we have this aggregate supply curve that looked like this, 1 plus m, What we did was we had these two equations, W equals PE F of U and Z, and W equals 1 over 1 plus M times P. So this was the markup equation, and this was the labor supply equation, or the wage setting equation, I think we called it in the book. And then we just set these two things equal, PE F of U and Z equals 1 over 1 plus M times P. Move that to the other side, and you get that equation. And so it's just the labor, this is just the labor market equilibrium. The unemployment price equilibrium that we worked out before. Now, we then said what you can do is approximate this equation as, first we let F of U and Z equal a specific thing, 1 minus alpha U plus Z. So we took a specific case for F of U and Z. So now we said, let me take one more step. So that P equals PE times 1 plus M times 1 minus alpha U plus Z. And then we can approximate this as, and the appendix shows you how, it just takes some math. I mean, you're not responsible for that. It's an approximation as the Phillips curve. P, inflation equals expected inflation plus M minus Z minus alpha U. And so we were able to get the Phillips curve just from the supply side of the economy. Between the price setting equation and the wage setting equation, looking at that equilibrium. and then that gives us a Phillips curve. And so if we plot then this equation, we said what it gives us is a relationship between unemployment and inflation. You can see the slope is minus alpha, and the intercept is this. This is just in slope-intercept form. This is the intercept part here. And so we have this Phillips curve. It's a negative relationship between unemployment and inflation. So this is all stuff we've already done, and this intercept is pi e plus and minus z. So if any of these things change, the Phillips curve would shift around. And it's just, we just have this negative relationship.
Is it minus here or plus? I haven't done
It's probably m plus z. I think I went through this before. Yeah, it's m plus z. Thanks. So it's a plus here. So in particular, when the inflation expectation changes, this thing shifts around. And so that's all stuff we've done, just to sort of review where we started. And then we started using this Phillips curve to sort of explain various things about the U.S. economy. Now, let me try something different, because I think that's probably, let me derive the Phillips curve a different way. Show you another way to sort of derive the Phillips curve. So what we've been trying to emphasize is that if you take and fix inflationary expectations at some value, whatever it is, as long as those inflationary expectations stay fixed, you have a particular trade-off between inflation and unemployment. And when those inflationary expectations change, that relationship shifts around. One way you can get at this is to use an aggregate demand, aggregate supply model. So let's do that. So here's output, here's prices, it's an aggregate demand curve, short run AS, PE equals PT minus 1. So I'm going to take a particular expectation that PE and T is PT minus 1. And we're going to keep that fixed for a little while. So your inflationary expectations here, PE minus PT minus 1, are 0, because those two things are equal. The expected price minus this price is 0, because your expected price is just yesterday's price. So this just means you're expecting 0 inflation. So I want to start off in a world where we're expecting 0 inflation. And that's where we're arguing the world up until about, say, the 1960s into the 70s. For all that time, prices were pretty flat. They varied around. On average, they didn't change very much. So it was reasonable to think that people had exactly this expectation. And so we're going to start off saying, well, if those expectations are fixed, we can get a fixed trade-off, a permanent trade-off, what looks like a permanent trade-off between inflation and unemployment, like it versus stutter. Now let's put the medium run supply curve on here as well. And this is Y star. So that's the natural rate. I think we can call it Y. So we can start off at the natural rate. And let's look at a change in money. So we're going to have, so right now money's not growing. Money's just stationary. And there's 0 inflation. Prices are stationary. The price is P0. The money supply is M0. Okay? And there's no inflation, so people are right to think this because the price never changes. So we're at the natural rate. Now suddenly money's going to start growing. The Fed decides, I don't want just a fixed money supply. We're going to increase the money growth rate to say 3%. that's going to cause this aggregate demand curve to shift out permanently. Because money will change every period. It's growing by 3% every period. So the aggregate demand. As that happens, you're going to move along the long-run supply curve, and it's going to force prices up, so we're going to get inflation. And as long as these expectations are fixed like this, we're going to be able to get a permanent trade. So let's say the Fed has some target they want to hit. Now, one way to tell this story is that the Fed is misperceiving the true natural rate of output. So let's say that the Fed thinks the natural rate of output is here. So that's why target. So what the Fed would do is say, okay, I'd like to hit this point, and so we're going to increase the aggregate money supply by that amount to hit our target. And in that time period, it works because people expect the prices to stay fixed, so we stay along the short supply curve. Now tomorrow comes along, and people say, oh, gosh, look at that. P1 was higher than P0, so I need to increase my expectations. So the next period, they're not going to think prices are going to be P0, but P1. They're going to look back and say, well, I think in period 2, prices will be P1. And so the short-run supply curve is going to shift back to this point. So this is for PE equals P0. So the short-run aggregate supply curve could shift back here to PE equals P1. So you with me so far? In the first period, we move to this point because price expectations are fixed, we move along the short-run supply curve. The next period, people say, oh, they look back to the previous period and say, we were wrong, let me change my expectations to P1. If they're correct, they'll be at the long-run supply curve, so the new short-run supply curve has to go to that point. Okay? So they're just using this PET equals PT minus 1, or 0 inflationary expectations. At the same time, what could the Fed do? Increase the money supply and stay one step ahead of them. So the Fed could increase the money supply to A, B, of M2. So you go from that point to that point. This is period 1, period 2. So period 0, period 1, period 2. The demand curve shifts back. The next period, the supply curve shifts back, but the demand curve shifts again, stays one period ahead of them. So the same thing's going to happen. The actual price level here will be P2. They thought it was going to be P1, but it actually turned out to be P2. So in time period 3, PE3 will be P2. They'll look back and say, oh, I was wrong. And so this short-run supply curve will shift to short-run AS PE equals P2. At the same time, the Fed could increase the money supply again and end up at that point. So this could go on forever. The Fed sort of has estimates of how the model works, or they just do enough stimulus to hit the target. What they're doing is just saying, oh, as this shifts back, I have to give more demand to shift it back out to hit their target. So what will happen over time is this will shift up at a fixed rate. We'll have inflation. But unemployment will be lower. We'll move ourselves above the natural rate. So if I were to go over here and say, okay, what's the relationship between unemployment and inflation? We started at 0, and we were at U star. or UN, sorry, wrong book. YN corresponds to UN, that's the full employment level of unemployment. Yeah? Then we cause unemployment to fall to U target, corresponding to Y target, in return for some amount of inflation. Prices are going up continuously. This just keeps going on. Supply back, demand out. Supply back, demand out. It just keeps moving right up. And it'll move up at a fixed rate. It'll be the same each time. And so long as expected inflation equals 0, I could have done the same thing on the other side by moving the demand in the other direction, targeting something over here. I'll get what looks like a fixed trade-off between inflation and unemployment. So long as inflationary expectations remain fixed at 0, we'll get what looks like a permanent trade-off between inflation and unemployment. There's one. So each period is 3. This is 3. In period 2, the expectation is P1 to control. So you get out in front of them. This shifts back, but you shift that out to compensate. They shift back to compensate for that. You stay one step ahead. It just keeps going on. Period 3, the price expectation is P2. But if you think about these are essentially the labor suppliers that have this price expectation. And that's how they're setting their wages, based upon that price expectation. So they use that price expectation to say what their wage should be for the year. What's happening here is every period, here they thought prices were going to be P0 and they turned out to be P1. Oh dang, we got it wrong. Here they thought prices were going to be P1, they turned out to be P2. Oh darn, we got it wrong, let's expect P2s. They expect P2, they get P3. They expect P3, they get P4. Eventually you might think that these people would say, you know, I keep thinking that prices are going to stay fixed forever at the last. When you say my expectation of today is yesterday, you don't think there's any inflation. There's been inflation going on forever, and you've been getting prices wrong because of it. Eventually you think you might begin to anticipate that inflation. Right? Because you're getting hurt. You're not demanding a high enough wage to compensate for prices. You think prices are going to be lower than they actually are, so you accept a lower wage than you should have. And so every period you're losing out. You're not getting the real wage you thought you were going to get. You're getting a lower real wage. It's an income transfer from you to the boss, to the firm, because they're not paying you as much as you thought you were going to get paid. That's not going to make you happy. So eventually you will say, oh, I'm not going to be so stupid as to think the price is going to stay fixed at the last level. I'm actually going to anticipate it's going to go up again during the next period. And I'm going to build that into my expectations. So you're going to start to anticipate the inflation. Once that happens, this changes. Because once you begin to anticipate exactly how much the aggregate demand curve is going to go up, you'll offset it immediately. So if you change your inflationary expectations, if you actually understand what's going on here. Let's look at the same thing. Medium run supply, short run AS, PE equals P0, AE and M0, P0. Now that you've caught on to the game, oh, there's inflation. I should think about that when I do my nominal wage demands. When this shifts out, you'll be ready for it, and this will completely offset it. And so you're going to have the same rate of inflation. As this demand curve is going to shift out at the same rate, and prices are going to go up, but you're going to be stuck at the natural rate. So once those inflationary expectations change, you move from this point. You have the same amount of inflation, but you move to the natural rate because you've anticipated the inflation. Seeing that? Now, if you shift the demand up even more than they expected, gave them even more inflation than they were expecting, yeah, that's going to give you a point off of this curve. And so what you have is a new Phillips curve where expected inflation is greater than 0. You change your expectation. And as long as you get the inflation you expect, you'll be at the natural rate. Now the only way to lower or increase unemployment is to change the demand curve by more or less than they expect. They're expecting this 3% increase in money every year. If suddenly you hit it with 6%, and don't tell them, that's going to have an effect. Then you can make this work again, so long as they don't update their expectations. So if they're expecting pi 1 and you give them pi 2, demand goes up twice as far as they're expecting, that's going to have an effect on unemployment and output. But only so long as they don't anticipate. Once they begin anticipating pi 2, you move to a point like that. Yes?
If they expect pi 1 and you give them pi 2, what happens?
So that's like, let me draw a picture of it. So here's AD 0, short run AS 0, medium runs here's pi 0. So let's call this AD expected. So that's how much they think, how much inflation they think there's going to be. So they shift the supply curve back to that based on the expected pi. And you actually give them more than, even more inflation, an even bigger increase in prices, then you're still going to have a real effect on output. So if they're expecting 3% and you give them 6% each period, you're still going to be able to move output above the natural rate or unemployment below it. But the minute they start anticipating this bigger shift, they'll shift back all the way to here. So the minute they change their expectations to 6%, they'll fully offset that. And that's when they move back to this point where they're expecting 6% and you're still at your natural rate. Then you have to give them 8%. You could also do the opposite. If you give them less than they expect, you move on this side. So that would be moving in the other direction on the Phillips curve. Then we said, well, we can use this model we've derived either from the way the book does it, or you can derive it graphically the way I just did. We can use this model to explain what happened in the world. So I said, okay, just to go back over everything. We started off in a world with a Phillips curve where inflationary expectations were 0. That was true, and we were probably near the natural rate of unemployment. Occasionally, inflation would differ. On average, it was 0, so people didn't change their expectations. But some years, sometimes it might be higher or lower. But people expected it to come back to 0 in the future. And so we had this trade-off. And this is what Phillips discovered, but they don't realize that it's based upon expectations. They think it's a permanent trade-off. Then in the 60s and 70s, they begin trying to exploit this trade-off. And so they target points like this. So they say, okay, let's move the unemployment rate lower than it is right now. And let's just accept the inflation that we'll need for that to happen. And they expected unemployment to fall. You make this permanent trade-off, and you end up here with an even lower unemployment rate and some inflation, but so what, we can handle that. Then what happened next? Once the inflation became ingrained into the economy, starting in the 60s and started gently rising in the 70s, it really came into play. People began to expect and build into their wage contracts actual inflation. And so they began to anticipate inflation and demand their wages be rising at a certain rate every year to compensate for the inflation they expect to become in the future. In the past, they hadn't been asking for wage increases every year just for inflation because they didn't expect it. Now they have to build it in. And that has the implication that the Phillips curve shifts. Pi e equals pi 1. Because if we're correct, we'll be back at the natural rate. And so we sort of go from point A to point B to point C. Not that direct of a path. There's probably more of an arc, but that's basically the story we have going in. And then policymakers said, oh, unemployment is still too high. Let's do even more inflation. Let's give them pi 2. Works for a little while. People change their expectations. And we end up in a world coming out of the 70s, 79, with really high inflation rates and nothing to show for it. And again, one of the reasons policymakers made this mistake, partly it was the oil price shocks and not knowing how to respond to them properly, but a big reason was there were a lot of demographic and other changes that raised the natural rate of unemployment. They shot at 4%, even though the natural rate was probably 6 or 7%. They kept saying, oh, the unemployment rate's too high, it's 6%. We need to get to 4%. Let's pump more money into the economy. Oh, we mustn't be giving it enough. Let's give it more, let's give it more. And you end up getting the inflation you were after, but again, you're at the natural rate. And that's where we ended up in the 70s. Then there's this big debate, and we'll put some numbers to this later today to actually look at what happened. But in 79, Volcker comes on the scene, and what's he do? He says, I'm going to lower the inflation rate by raising interest rates. So he comes in 79, and he spikes interest rates up. What's that do to inflation when you reduce the money supply? Basically, you reduce the growth rate of the money supply. And when you reduce the growth rate of the money supply, what happens to inflation? It falls. So what happened was we're stuck up here with this really high rate of inflation and unemployment at the natural rate. And inflation is costly when it's up in the teens, so they want to bring it down. So they say to themselves, okay, we have to lower the inflation rate to pi 1. So the central bank goes out and just we're going to reduce the growth rate of money and bring the inflation rate down to pi 1. And as I said last time we went through this, policymakers had been saying that since the 60s. We're going to get rid of inflation, we're going to get inflation. They never did, so they had no credibility. Nobody believed them. When they said, we're going to change inflation from pi 2 to pi 1, people said, no, you're not. It'll be pi 2, it might even be higher, because that's what's happened in the past. And so they kept their inflationary expectations at pi 2. So when Volcker actually lowered the inflation rate, it had a huge impact on unemployment. So in 1982, unemployment went up to over 10%. I think it was 10.2 or something like that. It really went up a lot. But eventually, though, what happens? People went, oh, this Volcker guy seems to be different than all those past Fed people who are lying to us all about what was going to happen to inflation. It seems to have actually happened. And so after a while, by 82, so it was very deep, but pretty brief recession, because eventually people said, oh, okay, we can start lowering our wage demands. We can start expecting less inflation. And when that happened, this Phillips curve shifted back in it. Then they wanted to lower it, say, to pi 0. Once again. But this time they had some credibility as they came into the 80s. So beginning about 84, the Fed had a lot more credibility with the public when it said it was going to do something it had in the past. And so at that time when they said we're going to lower the inflation rate to pi 0, people mostly believed them. Not everyone, but they mostly believed them. Maybe not all the way, maybe it's only shifted down part of the way, but let's say they fully believed them. Now what you can do is move, instead of having gone from A to B to C and paying this huge cost in unemployment, if you have credibility, you can move directly from C to D. Because if you say you're going to do something, people believe you and change their expectations right away, then you can have a much smaller cost to unemployment. So there was a big debate in the 1970s and early 80s about how costly the disinflation would be. And we'll come back and talk a little more about that today. So just sort of keep this in mind as we're talking about the cost of disinflation later, because it's going to be exactly the story again. Anyway, this is all stuff we've done before. I just wanted to sort of go back over how to use these Phillips curves. Any questions about them? None? Okay, so some warnings about using Phillips curves as a policy tool. So, first, before the warnings, aggregate supply is well captured. If you take it to the data, it does a pretty good job in aggregate. As a relationship between the change in the inflation rate and the deviation of unemployment from the natural rate. That is the model we developed last time that said, let me get it exactly right. Oops, very good. Try that. So last time we worked out show that you can write that inflation is expected inflation minus alpha times u minus the natural rate. What we're saying here is that if you want to capture US data, if you make that pi t minus 1, so that the difference in the inflation rate is related to the deviation of unemployment from the natural rate. So what this says is when U goes up, inflation falls. When U goes down, inflation goes up. And so in US data, that seems to hold pretty well since the 1970s. But there's some time periods and some other things to think about where that relationship breaks down. So it works pretty well in aggregate a lot of the time, but we want to say when it doesn't. What are some cautions here about it? So one thing that's different to think about is there's lots of variation in the natural rate of unemployment across countries. The natural rate depends upon monopoly power, that's Z. So there's lots of variation in the amount of monopoly power in various countries around the world. And this is factors that sort of capture labor's bargaining power. And so in European countries, for instance, you have a much different structure for labor markets. Laborers have much more protections than they have in the US, same in Scandinavian countries. So you might think that this natural rate of unemployment, this thing here, varies a lot across countries. So we shouldn't think there's one Phillips curve that holds everywhere and always with the same natural rate. So there's a lot of variation in the Phillips curves across countries just for that reason. So this is cross-country variation. There's also cross-time variation in the natural rate and some other things. So within the US, the UN has changed a lot due to demographic changes. So over time, this natural rate of unemployment shifts around a lot. The baby boom had a big effect on the natural rate of unemployment. For instance, as the baby boomers entered the labor market, as we said before, there was a lot of frictional unemployment, and that tossed the natural rate of unemployment up. A lot of structural change, various times going on now. Times of structural change, you tend to see people displaced from existing occupations, trying to find new work, and the natural rate goes up. We think with all of the deregulations, you might argue that with all the deregulations since the 1980s, maybe even the 70s under Reagan and others, that the degree of monopoly power has changed. Maybe the degree of antitrust enforcement varies by administration. Maybe Democrats and Republicans have different ideas about how aggressive you should be in attacking businesses of monopoly power. So you might see M varying a lot over time. So there's all sorts of reasons to think that the natural rate changes in unions would be have a big effect on labor's bargaining power. That'd be a change in Z over time. So changes in unions are another reason why we might think that the natural rate varied over time. So if you look at the US and just look at the average unemployment rate, which is it's an okay measure of sort of, it's an approximation of the natural rate. Just take the average, so the odd average we're at it. It was about 4.5%. This is unemployment in the 1950s. So it's pretty low. It was 7.3% in the 1980s. So it's probably the case the natural rate was a lot higher in the 80s than it was in the 50s. It was 5.7% from 90 to 2000. It was about 5.0 from 2000 to 2007. So we seem to have, the natural rate seems to have been very low in the 50s and early 60s, and really have spiked up in the 70s and 80s, and it's been coming down ever since, it looks like. So there's a lot of variation in the natural rate over time. Okay, the next part of the book is just the credibility story we've been talking about. Let's go through that a little bit. So these are just things to watch out for when you're using the natural rate. So the point here is that you really need to be careful when you're specifying your Phillips curve model to get your natural rate right. And it'll vary a lot over time. You're not thinking it's some fixed figure. Okay, in 1979, this is the time period I was talking about, we're up at the top of that Phillips curve of high inflation. The unemployment rate was 5.8%. That's not so bad, maybe a little high, but inflation was 13%. So we had really high inflation. Some of this was due to oil prices. But that's probably only about 3%. Inflation probably would equal about 10% without the price of oil going up. So the point is, it's not right to think of this time period as inflation being caused purely by oil price shocks. Yeah, they had an effect, but something else was going on. And part of what was going on was high money growth rates. And that's what Volcker comes in and stops, are those high money growth rates. They're causing this underlying rate of inflation. So again, Volcker comes in, so how to get unemployment or inflation to go down. It seems like we must accept that unemployment will go up for a while. So that's that Phillips curve model where we want to lower the rate of inflation. If you don't have credibility, you have to pay this unemployment cost. Remember that, how that worked? So that's what we're saying. We're just verbally describing what those graphs were telling us and putting some numbers to it. But there was a big debate at that time about how much unemployment had to go up, how much cost did you have to pay for the fall in inflation. And so remember that our model is pi t minus 1 equals minus alpha times u minus n. This is the change in the inflation rate. So if we want inflation to go down, what do we have to do? Have unemployment above the natural rate. Then it'll keep falling over time. And it's really a question about the size of alpha. How much does unemployment have to go up to get a particular fall in inflation? What's the cost going to be? And there were two groups. So if you just use this model, we said a good estimate of alpha was 0.55. So alpha hat, 0.55, that's a good estimate. Hat over a thing means estimated value. So we use econometrics to go out there to figure out, use actual data on these things to figure out what alpha is. It looks like it's about 0.55. So if unemployment goes up by 1%, inflation goes down by 0.55%. So that's our trade-off between inflation and unemployment. So to get inflation down from 10% to 4%. According to this, if you do it in one period, you need unemployment to go up by approximately 10%. The formula is that it's the actual value is 10 minus 4 over 0.55. If you use this to figure out how much unemployment has to go up, this is the formula. If you want to go from 10 to 4, then you divide by that alpha, you get this 10% unemployment cost. Yeah.
What's that for one factor?
What's that?
Unemployment, what's that?
1%. If unemployment goes up by 1, so this is minus 0.55. Start off with U equals UN. So unemployment go up by 1. This goes down by 0.55. So that's your trade-off. So you get a 1% change in inflation. You need a little less than a 2%. You need 1.8% increase in unemployment. So basically, you need 6 times 1.8, which is about 10, in order to get 1.8 is 1 over 1.55. So it's a huge cost. So when people in 79 were using the Phillips curve model to predict what was going to happen to the unemployment rate when Volcker tried to reduce inflation from, say, 10 to 4% or whatever, it was this huge, huge cost. So the conclusion was that disinflation is very costly. But there was another group that said that wasn't correct. And they said that, and this is something known, Robert Lucas was one of the people, but this comes under the guise of something called the Lucas critique. And what the Lucas critique says is that if you look at the data and estimate a relation, if you estimate a relationship based upon past data, and then you change policy based upon those estimates may no longer be valid because people will change the way they behave. So suppose that you send someone out to sort of hide, and they measure the speed on some street in Eugene, and they say, okay, we've been doing this for 2 weeks, and based upon our data, there are 25 speeding cars an hour. So based upon the past data, we're going to make this much money in traffic tickets if we send a cop out there. Now they change their policy and they send the cop out there. And people see them or they do it on their phone and say, hey, when you go to work today, there's a cop sitting there. And they look at all those apps on there that you can get to tell you where they are. And people change their behavior and suddenly there's only 10 cars that are speeding. So your estimate of how much revenue you were going to earn based upon past data gets blown apart when you actually try to exploit those estimates and change policy because people change their behavior. So they behave one way under one policy, and that's what's in the data. You change the policy, they change the way they behave. They change their expectations. I expect a cop to be there. I'll go speed down some other street to go to work. Or I'll slow down. I'll change my behavior so I don't get hurt, so it's not costly. Just like you change your behavior if you're losing your wage, so it's not to get hurt. And so maybe it's the case that people, when the Fed changes its behavior, see, they would change their expectations. So we have this model that says pi ET equals pi t minus 1. That's our expectations mechanism, and that's what's behind these estimates of how costly it's going to be. And this is the way people form their expectations. What Lucas was saying with his critique is that this may no longer hold once you change the way you're conducting monetary policy. So if you change the behavior of the policy makers, you change the way we're conducting policy, maybe people will expect that. They won't just expect inflation last period, they'll actually expect you to lower it. See, this says I expect inflation to be whatever it is yesterday. At the same time, the Fed is saying we're going to lower the inflation rate. Well, if they have credibility in their belief, you're not going to think it's going to be pi t minus 1, you're going to think it's going to be lower, right? And so people wouldn't have this expectation if they believed the Fed saying, tomorrow we're going to lower the inflation rate. Well, it's not going to be the same as it was today, it's going to be even lower. And so the minute they change those expectations, that's like that second case I saw where the Fed has credibility. And if they have credibility, they can change expectations to be lower, and that shifts the Phillips curve back in right as you lower the inflation rate, and it's not as costly. I mean, this is the story that, okay, we have this high inflation rate. We want to lower it. If people don't believe us and we tell them we're going to lower it to pi 1, then we have to pay this big cost. So if they keep thinking inflation was what it was yesterday, so if Phillips curve, if the expected inflation today is what it was yesterday, you're going to move to this point. But if you believe the Fed, you're going to move, you're going to change your expectation. And you'll go to this point. So you can go from A to B, that's with no credibility. Or you can go A to C, A to B prime, and that's with credibility. That's where you're believed. And so there's hardly any cost of lowering the inflation rate if people's expectations, if they actually expect a lower inflation rate and not the one they believed yesterday. And Lucas was saying, hey, every time I look at the world and tell all these stories, suppose you're a tax collector and you say, okay, I'm just going to go, I want a 20% tax rate, so I'll just show up at your business on Tuesday at the end of the day and take whatever sales you had that day as the taxes. Well, obviously people would do everything they could to shift their sales to off that day. So when you actually showed up, you wouldn't get the revenue you thought you were going to get. You'd get much, much less. And so again, people changing their behavior, the estimates based upon the past data just don't work. And then it's the same thing here. People change their expectations, and this notion it's going to be very costly wouldn't hold. So then, who is right? So the cost depends upon credibility. So here's some data. The unemployment rate, CPI-based inflation measure, and GDP growth. And that's going to be for a bunch of years, 79 through 85. So 5.8, 7.1, 7.6, 9.7, 9.6, 7.5, 7.2. So it's looking like maybe Lucas wasn't so right here, huh? The Lucas gang. Because it looks like there was a substantial increase in unemployment. Did they bring the inflation rate down? it was 13.3% in 79, 12.5 in 80, 8.9 in 81, 3.8 in 82. So they really brought it down from, we went from 10 to 4, you know, it's 13 to 3, 3.8, 3.9, 3.8. So then it stabilized at around 3.8%. But it looks like the story I've been telling earlier was right, that the Fed had no credibility. See, Lucas was arguing when the Fed announced something, people would believe it, and that would make it not very costly as you go from A to B prime. But that's not what happened. In fact, unemployment went up substantially as they fought inflation. They were successful, but the unemployment cost was pretty high. And eventually the unemployment rate came down. And into the 90s, it fell down back around 4 or 5%. And we kept bringing that inflation rate down even further to about 2%. So it was much less costly in those subsequent years to bring inflation down even further. Once the Fed had established that it has credibility, that it's going to keep its word when it says we're going to lower the inflation rate. And so the Fed has really been careful to try to do exactly what it says so people will believe them. And when it needs to change the inflation rate up or down, you won't have to pay a big cost in terms of unemployment. High inflation. This is the case where the Phillips curve is likely to change. So another thing to worry about when you're doing a Phillips curve analysis is that if you have really high inflation, the Phillips curve probably gets steeper. Let's see if we can figure out why. One reason why it changes is wage indexation. So when you have really high inflation rates, you tend to see wages being indexed to the inflation rate. They just move automatically. As soon as data on the inflation rate comes out, the wages adjust automatically. You see this in a lot of things now. In the 1970s, a lot of people went to wage indexation, and that's still with us. This is going to lead to a stronger response. We'll show this. Inflation to unemployment. That alpha is going to get bigger. Now, that alpha parameter is going to get bigger. So think of an economy with two types of wage contracts. I guess I have to stop. So, let me finish this part. I guess I'm supposed to stop here. So. Yeah. One, a proportion lambda, that's a fraction between 0 and 1, is indexed. So W moves with prices. So whenever prices change, wages change automatically. And then the rest of the wages, proportion 1 minus lambda, are not indexed. And that's probably a reasonable approximation. You have to worry about what the fraction is. There's probably some are and some aren't. these set wages based upon inflationary expectations. So we want to see how that changes the Phillips curve. We'll see it changes that alpha parameter. After today, no more of this stuff. We're going to go on to growth. So this is the end of this part of the stuff. So, anyway, we should take a break, and I'll pick it up here. All right. I would think, of course, that 370 would be good. It's a lot of present value. Just, 470 is the higher end. There are courses in exchange rates, labor, public economics.
Microphone's on
Oh, yeah. Right. If you have credit, you start to make a mistake. I agree with what you said. The public believes you as a lot. And so they didn't believe it, so they didn't change their expectations, so they actually did. If they believed them, this would have shifted because expectations would have changed and they got to, they go straight from there. That's all. things, and I'm gonna try to figure out a way to liven things up somehow, some way. Partly me. My flight got in late last night, and I got to take another one tomorrow, so I stayed up really late. Catch up.
How late?
Really, Okay, so let's finish this, then one more point. And then we'll move on to something entirely new. We'll be done with Phillips curves and ADAS and all that for a while. And we'll move on to growth models, which is an entirely different sort of thing. The graphs are much easier, I think. So I think bear with it a little longer, and then we'll get on to something that's a bit different. So anyway, the question, the big point here, we're going to use some algebra to show it, but I don't want to lose what we're trying to show here. And what we're trying to show is that in a high inflation environment, the Phillips curve changes. So we're trying to figure out when this Phillips curve relationship we've estimated moves around, changes its nature. One was when the natural rate changes, and that's across countries and across time for various reasons. Another is when expectations change, that thing will shift around. So there's those things on the axis, pi, e, m, and z, all change over time and across countries, and those are going to give you different Phillips curve relationships. Now we're going to look at sort of the slope of the Phillips curve. We're going to argue that in a high inflation environment, the slope of the Phillips curve changes. The trade-off between inflation and unemployment changes. So we're starting in a world where we have some wages that are indexed to inflation automatically, some that aren't. In that world, the Phillips curve becomes pi t is lambda pi t plus 1 minus lambda pi t e minus alpha ut minus ua. So for this model, that's the right Phillips curve. This is sort of the expected growth. These are the wages that move automatically. These are the index wages. So this moves automatically. And these are the wages that are set that are not indexed, that are set based upon expected inflation. So this is 2, and 1 on the left is 1. So this would be the Phillips curve relationship. Now if we put in, if we assume, like before, that pi at t is pi t minus 1, you'll get inflation is lambda pi t plus 1 minus lambda pi t minus 1 minus alpha times ut minus ua. And then you can show then that pi t minus pi t minus 1 is alpha over 1 minus lambda minus alpha over 1 minus lambda times ut minus ua. So this is the difference. Before it was just minus alpha, now it's minus alpha over 1 minus lambda. So what we're saying is that the slope of the Phillips curve changes. Before the Phillips curves had a slope of minus alpha, now its slope is minus alpha over 1 minus lambda. And alpha over 1 minus lambda is greater than alpha because this is between 0 and 1. So this is a fraction. So when you divide by a fraction, you get a bigger number. And so you get a steeper trade-off. So when UT goes up, when U goes up, you get a bigger increase in inflation than before. All right, UT goes down. The reason is simple. With no indexation, when unemployment goes down, wages go up. That causes prices to go up, and it ends there. So unemployment goes down, you get some inflation. With indexation, what happens? Unemployment goes down, wages go up. Same story so far. Prices go up. But that causes wages to go up because they're indexed. Right? And wages to go up, we're going to cause prices to go up, we're going to cause wages to go up. This will eventually converge, but you get a bigger increase in prices than before with indexation for that reason. Okay, so that's high inflation, the Phillips curve breaks down. What about when there's low inflation? As in recessions. So one of the big things that's been sort of going around the blog world and other discussions is that the Phillips curve really seems to have broken down in the Great Recession. If you look at the Great Depression, the same thing seems to have happened. The Phillips curve doesn't seem to fit very well in these high unemployment, low inflation environments. And what happens, so in recessions, inflation falls, but not as much as the Phillips curve would predict. So you see that you get a different relationship. If you look at the data and kind of plot them out over the last 20, 30 years and put the Great Recession in different colors, you can clearly see it's off the pattern from the other data. Why would this be? Any ideas? Why might not inflation fall? What's inflation sort of based upon? Costs of production? What's the biggest cost of production? 70% or so. Wages. So what we need for inflation to fall is for wages to fall. So if inflation's not falling, what must be happening to wages? They must not be falling either. And so maybe it's because of downward wage rigidity. The Phillips curve predicts all this disinflation. Inflation should have been highly negative and given the unemployment. Unemployment went up to 10%. We have this huge gap between inflation and unemployment. According to the Phillips curve model from normal years, inflation should have been really falling. That's one of the reasons the Fed did QE. They were really worried about disinflation and deflation, because that can be really, really costly. But it just didn't seem to happen. Maybe it was QE, maybe the Fed just stopped it. But I think a better explanation is that we have downward wage rigidity. That seems to be the reason why the Phillips curve breaks down. So Have this Phillips curve, tells you a pretty good story in normal years. It's bad when inflation's high. It's bad when inflation's abnormally low, like in recessions. It varies across countries. It varies across time. So in recessions, you don't get enough deflation, as the model predicts. When inflation's really high, the trade-off changes, the slope gets steeper, and the natural rate jumps around across countries and across time, and inflationary expectations also change. So for all those reasons, you have to be careful about thinking the Phillips curve is just this one case. Okay. We're going to go on to chapter 10. And now we're going to move on to the long run. We're done with the silly medium run. I know you're just really sad about that. I wish we could drone on about this for like another 2 or 3 classes. Maybe do the full mathematical treatment too. But I think we'll go on. So chapter 10. So we're going to move on to the long run. For the short run was when expectations aren't necessarily correct. Medium run was expectations are right. The long run is all about economic growth. So chapter 10 is the facts of growth. So what we're trying to figure out here is what kinds of phenomena, what kinds of things should our model be able to tell us, to predict. So why do we care about growth? Is that gonna, why do we focus on? For some economists, we've been looking at really stabilization, which is business cycles, and how to use policy tools like government spending and taxes to keep output close to the natural rate. So our model is all about sort of stabilization. We don't really worry about YN and how it moves around and what causes it. Some people think that growth is really all that matters, that all that stabilization stuff is sort of second order importance relative to growth. Why do we care about growth? What's growth do for us? It raises standard of living, right? So what would be a good measure of the standard of living? So why do we care about growth? Because it increases standard of living. Okay, fine. How do we want to measure the standard of living? GDP is one possibility. 2 countries can have the same GDP, and one could have 11 people, and one could have 7 billion. Where would you want to live? One of the lucky 11. So maybe we want to look at GDP per person, per capita per person. So GDP per person might be a better measure. There's also a lot of recent literature out there that tries to look at happiness. So you might try to use, not how much stuff you have. Maybe it doesn't make you happy after all. It's sort of how happy each person, the average person is in a particular economy, and how that happiness varies with GDP per capita and other sorts of things. It looks like it might, there's a long dispute about this, but maybe happiness levels off at some point. And so if there's a huge cost to growth in terms of environmental and other issues, and happiness is leveling off, maybe growth isn't so good after all. So maybe just looking at GDP per person isn't the end all to measuring what we really want to measure when we think of the quality of life and the standard of living. So I think, GDP per person is a good measure, but we need to realize that there's other things that you might want to factor in there. That's sort of the benefit. You'd also want to look at the cost of growth and make sure that the benefit of more growth is equal, it exceeds the cost that you're paying in terms of resource extraction and what you're doing in your environment, those sorts of things to the economy. But anyway, we're just going to use this GDP per person as an approximation to what we want to measure as the standard of living. When comparing across countries, well, there's all sorts of pitfalls there. We want to know, is the standard of living better in this country or that country? Two things we need to control for. Are exchange rates. We need to compare them in a common currency. I make $100 per, in the U.S., it's, 38,000 per person or whatever. And in this other country, it's, 2,700 euros, 27,000 euros, which is better. Well, we need to know what the exchange rate between those two currencies are before we can compare those two standards of living. The other thing that you might worry about are differences in prices. So you have the same income per capita and GDP income, same thing. Same income per capita per person in two countries, but the price of goods and services might be way lower in one country than it is in another. So that your income isn't all you need to know about when you're measuring standard of living. So if you live in a country where labor is really cheap, maybe you can hire people to do all sorts of stuff for you for almost nothing. And so your standard of living is very different than someone who lives in a country where hiring those services would be very expensive. And so it really depends upon, you have to control those two things. So, numbers that adjust for this. Adjust for these factors are called PPP, purchasing power parity. And PPP is purchasing power parity. So if you just do a raw comparison between, if you look at GDP per person for the US versus India, if you use the unadjusted numbers, take the ratio of GDP per person in the US to GDP per person in India, it's about 36. If you adjust to PPP, you get about 14. So it can make a big difference when you're comparing across countries to account for these factors. Prices are much lower for lots of services in India, for instance. Hiring someone to clean your house is probably a lot cheaper in Mexico than it is in the US. And it's cheaper in San Diego than it is here. The other thing we might worry about with GDP per capita, so I added something that wasn't in the book for initially, which is we also want to look at the cost of growth and make sure it's worth the benefits. Here we're saying be careful comparing across countries for exchange rate and differences in prices. It's also the case is what matters is consumption. So you might want to look at consumption per person. So for instance, in China, they have a huge amount of investment. So when you look at C plus I plus G, I is a way, 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 way bigger component of GDP in China than it is in the US. Their savings rates are way higher. So if you were to look at consumption per person versus GDP per person in China, you get a very different picture. And so maybe we don't want to look at GDP per person, but consumption per person. And the other point I'll raise is you might also be interested in the distribution of income as well. And so distributional issues might also matter when comparing the standard of living in two countries. If there's a highly unequal society, the average might not represent what you want it to represent. And so you might want to be careful comparing countries that have vastly different income distribution. Just because they have the same GDP per capita doesn't mean that sort of the median standard of living is the same in both countries. Another thing you can look at, sometimes you're interested in production. Knowing about productivity differences across country, this is going to come up as we look at growth. So here, the measure we want to look at is output per worker. Can you think of any problems though with that? What might be even a better measure? What if in one country people work 6 hours a day, in another country they work 12? Does that measure work in those two, comparing those two countries? No. So you might want to look at output per hour. So that might be a good measure of productivity across countries. So for standards of living, we tend to look at GDP per person, with the caveats I mentioned. For productivity, output per hour is the measure you want to look at. And that's not perfect either. I won't go through all the potential problems with it, if that's what we're going to be using as we look at productivity. If you look at growth rates across countries, let me just, this is right from the book. So let's look at France, Japan. These are developed countries. UK, US, and the average. Several columns here. So this is the annual growth rate of output per person from 1950 through 2009. That's one column. Then we're going to look at real output per person in 2005 dollars. That doesn't really matter. For several, in 1950, 2009, and then the ratio of 2009 to 1950. So France, 2.5, Japan, 3.9, UK, 2.0, 1.9. Does it surprise you that France had a stronger growth rate? The average across those countries is 2.6%. So that's a average percentage change in GDP per person.
Is it like there are more people, small people in France and more people in the US?
What's that?
Is it just like more people in the US and small people in France?
So we're big in the US and small?
I
Is that a little short term? Is that what you're saying?
I think
It could also be that you're starting from a smaller base. So when you go from 1 to 2, that's 100% growth. You go from 1,000 to 1,001, that's only 1/1,000th, even though the changes are the same. And so one thing that could be going on here with Japan is they started from a much lower GDP base, and so it was easier for them to make big gains. I don't know what extent that's true in France. UK and the US are about the same. But when you look at a number like China and you look at average growth, that's clearly the case. They start from such a low base. It's easy to make big percentage changes. And it'll be much harder as that base cranks up to keep growing at the same percent. So 8%, yeah. So these are in dollars. So in France in 1950, income was about $7,112. By 2009, it was $30,821. So that's about a 4.3 increase. So over a period of about 60 years, GDP per person, the amount of stuff you have in your house and so on, has grown by a factor of 4.3. So you have a lot more than your grandparents. They didn't have cell phones. When they were your age, or anything like it. They'll tell you the stories if you like. 3,000, Japan starts from 3,108, so they're starting from a much lower base. This is what I was saying. And then they go up to 31,958. So that's a 10.2. So there's been a huge increase in the standard of living over time in France. UK starts at 10,400. Remember, these are all in real constant dollars, so we're adjusting for inflation and all that. 10,000, and it goes to 33,386. So that's about only a 3.2% jump.
I have a question. What's the difference between the left number and the right number?
They're both in dollars. This is 1950.
You talk about like the annual growth output per person and then the right.
These are the levels. So this is how much GDP per person has grown. So these are the growth rates. This is what it was in 1950. So if I take GDP divided by population for France, I'll get this number.
But what about like the one all the way to the right?
Oh, that's this divided by this. It's 2009 over 1950. So it's the ratio of income here to here.
What makes that different from annual growth output per person? Why aren't those the same numbers?
Because
Like why did Japan jump from 3.9 to 10.2? And every other country is just by one. There's a difference.
this is just the ratio of the levels. If I take this and let it grow for 2.5% over those years, this is 1950 to 2009. If I take 7,112 times 1 plus 2.5, I'll get the number in 1951. Then I do that again, I get 52. If I keep doing that growth rate, it'll grow to 30,821. But the ratio, so that's the rate at which it's grown. The ratio of incomes is just the ratio of this to this. So that's a measure of how many times the standard deviation, or that's a measure of how many times the standard of living has doubled. So you have 4.3, because it's grown at this rate, you have 4.3 times as much stuff now as you had back then. That's like a 400% overall. This is like 400.3% growth. Because it's grown by 4 times. If I divide that by 60, I'll get about this 2.5.
Okay.
For the U.S., it's gone from 13,183 to 41,102. And for us, it's been about 3.1. And the average is 5.2 over those countries. 8453, 34 through 10. 317. Not that it matters that much. Kind of missed on the right-hand column. So one of the big points we want to take out of this is, so what are we trying to demonstrate? What facts do we need to be able to explain with a growth model? Well, one is simply that there's a large increase in GDP over time. GDP per capita, per person, over time. It's clearly grown at a fairly rapid rate. But even more, you can see there's a lot of variation in these numbers. This one is almost 4 times this one. But look how much closer things are here. So it looks like there's convergence in the standard of living across countries. And our standards of living are becoming more and more and more equal over time. Now, that's not true in every country. You can find exceptions. You can even find countries that are going in the wrong direction. Just go bomb somebody, and they'll lose all the productive capacity in their GDP. You know, some countries that were recently wiped out from war certainly are going in the wrong direction. Even countries that haven't had that happen, that's happening too. So, and these are all developed countries. Whether the convergence hypothesis applies to developing countries is a little bit, we don't know. There's all these questions. But anyway, among developing countries at least, it does appear that there's been convergence in the standard of living over time. So rapid growth and convergence. So, how are we going to model growth then? What kind of model of growth will we use? So here comes the algebra stuff. But it's stuff I think you've seen. I hope you've seen. CAD Micro, you should have seen it. So thinking about growth. This is sort of an introduction to the next chapter where it really starts to get into more detail. So we're going to use a framework from Robert Solow, a growth model developed by Robert Solow. The Solow growth model, it's what he got the Nobel Prize for in the late 50s. We're still using it. And what he came up with was an aggregate production function. That relates aggregate inputs to aggregate output. So last chapter, up until now, our model has just been outputs a function of just labor. That we've taken the simplest possible production function, y equals m. Now we need to generalize that some because we're going to talk about growth. So we're going to write it as y equals f of k and n. So this is aggregate capital, plants and equipment, that kind of stuff. This is the number of workers, like the 4. This is aggregate output. and technology is embedded in the function f. I'll give you an example. So we're going to say that aggregate output depends upon how much capital we have and how many people are working. So we bring people and machines together. And they use some technology, and that technology is described by this function. And those people give us a certain amount of output. As productivity grows over time, as we get more and more productive, for instance, the same K and N, that's technology, get more productivity would give us more output. This is called a Cobb-Douglas. You could say Y is A times K to the alpha, L to the beta. And so that's the function F. That's the production function. It's called the Cobb-Douglas production function. And so I could give this, these are parameters. A, alpha, and beta are just numbers. This might be 1/2, this might be 1/4, something like that. This might be make them the same. Something like that. Okay. And A is just some number. In this function, A represents technology. Over time, if A gets bigger, what's that mean? Now, when you go, because that's an increase in productivity. Because the same amount of capital and the same amount of labor would give us even more output if A was bigger. So if I give this the same L, the same K, make A bigger, I get more Y. So this tells me for any K and L what Y will be, and it tells me how technical. Sometimes you might want to say AT, KT, LT, and YT. So the capital at time t, the labor at time t. So as population grows, you might get output growth. As our capital stock grows, you might get output growth, and so on. Now, we often assume constant returns to scale. If you had my growth, or if you had 311, you know what that means, right? What's it mean? If you double the inputs, you double the output. What it really means, the assumption in aggregate is that we can always duplicate the existing technology. So you can kind of expand a town, you get another 7-Eleven, another gas station, another factory. You know, we can pretty much do what we're doing is sort of replicate the existing technology. So we just take all the existing technology and sort of just double the amount of stuff we have. We're going to double output. Just do it exactly the same as we did before. So we're going to assume constant returns to scale. In this model, what that means is you have 1 minus alpha here, those coefficients sum to 1. If I double K and L, I would double Y. With those coefficients sum to 1. Where alpha is between 0 and 1. So that's a constant return scale Cobb-Douglas technology. Watch. So if I have Y equals A, K to the alpha, L to the 1 minus alpha, now let me double these two things. Okay. So let's look at A times 2K to the alpha, 2L to the 1 minus alpha. Okay. Let's double our inputs and see what happens. That's the same as A times 2 to the alpha times 2 to the 1 minus alpha times K to the alpha, L to the alpha. I just factored the 2's out. See that? Remember, like basis, add exponents? Someone drilled that into me in high school. So, what's that plus that equal? 2, or 1, so this is 2. So this is 2a, k to the alpha, l to the alpha. But what's this? Y. So that's 2y. So if I double the inputs, I double the output. It's constant returns to scale. So that's what we mean by CRS technology. And again, in aggregate, it's based on the notion that we can always sort of duplicate the stuff we're already doing. Exactly the same. There's no. So we're mostly going to use, the book just doesn't bother to give us a specific example. So it just uses this, and we're going to assume you have constant returns to scale. So that's what happens if we change both factors. What if only one factor increases? So what if we increase labor holding capital constant, or increase capital holding labor constant? Then we don't have this constant returns to scale again. In this case, we have diminishing marginal returns. That's not the word I want. We'll have decreasing returns to the factor. So if we just keep adding more and more labor to the same amount of capital, so we start with a certain amount of capital, we add more and more labor. Each additional labor will be add less and less to output. So there's diminishing marginal returns to individual factors. It's only when we scale them both up and down in proportion that we get the constant returns to scale. So if you if you take that production function, productivity is the change in output. I don't care if you know how to do this. So what would that be? That would be 1 minus alpha A k to the alpha times L to the minus alpha, right? So that's what we mean by productivity. How much output goes up when we add one more labor. So that's 1 minus alpha A times K over L to the alpha. So what happens as L goes to infinity? Productivity goes to 0. So as we add more and more and more and more L, productivity falls. So that's an assumption that we have in this model. So scaling both up and down, constant returns, we can double. Increasing one, if I did the same thing for here, I'll get a similar, it'll just be L over K to the 1 minus alpha. So you get exactly the same result for capital. So we have diminishing marginal returns to each individual factor. Okay. With constant returns to scale, there's one more thing you can do that will be useful as we start to look at growth. So y is f of k and n. It turns out with constant returns to scale, I can divide through by n and I'll get this, f of k over n and 1. So this is the measure we're after. This is the standard of living, output per worker. What we see is the standard of living depends importantly upon capital per worker. And so in growth models, one of the key things that impact our standard of living as we've measured it is the amount of capital that you have per worker. If labor grows, but your capital stock isn't, your standard of living would be falling. If capital grows, but labor grows faster than labor, your standard of living will be rising. So your standard of living is going to depend upon that growth rate. I see why you're all getting up to leave. Between, I was thinking we had till 6:20, I was ready to go. So yeah, I'll shut up now.